Good afternoon, folks. I'm Gordon McArthur. I'm CEO and founder of Beeks Financial Cloud.
Simon Goulding, CFO of Beeks Financial Cloud.
So, Beeks Financial Cloud, we are a cloud computing company, organisation solely focused on financial markets. So anyone who is doing any form of trading across now any asset class, that we cover all asset classes now, is potentially interested in our infrastructure as a service offering. So we are the server and the compute guys. So we do not offer any trading applications, any liquidity, anything like that. We are the technology vendor and an infrastructure as a service provider into cross-asset class financial markets. So this chart is really trying to distill down what we do into a single diagram. So our cloud platform is the server and the network connectivity. So we are, one of our USPs is we are connected directly to almost 200 exchanges or trading venues around the world. We now have 11 data centers around the world. We've recently opened latest two, one in Singapore, SGX, and our third data center in London to support the London Metal Exchange. So across our 11 data centers, we have 200 pre-built direct, private, secure network connections to trading venues or exchanges. And that means you can get from our cloud environment to the exchange in anywhere under 1 millisecond, which is really fast enough for 95% of market participants, we believe. So our mantra is to be to offer flexible infrastructure options, all in 30-day commitments. We try and utilise the true cloud model. It's very easy to put cloud in front of your title now, but to me, cloud means self-service, no long-term commitment, and ability to manage your own infrastructure or application, whatever it may be. And that's what we do. Historically, our bread and butter has been putting the infrastructure around in all the data centres around the world. And over the last year or so, we have been putting a software wrapper that sits on top of that allows customers, for a financial institution of any size, shape or scale, to manage their own infrastructure, to deploy into any of our data centres around the world without necessarily engaging us directly to get a sales quote or for us to have to build any environment. So this is our current global footprint. It has changed a little bit, as I just said, over the last 6 or 7 months, with the addition of SGX in Singapore, which went live about 6 weeks ago. We have our first anchor client that went live with us in Singapore, and we've had another couple join us since, so it's been a good start. We also deployed into London 1, which is the yellow triangle up there, which is an interaction data centre in the centre of London, which houses the LME exchange. So we connect directly into the LME for anyone looking to trade the London Metal Exchange. And the black dotted lines is our what we call what's called WAN connectivity, so a wide area network. So more and more customers and clients are asking for secure connectivity between our sites around the world. So we don't run the cables ourselves. We buy low latency connectivity, point-to-point fibre between some of the major data centres around the world, and allow our clients to again utilise that in the cloud model. So as I say, the black dotted lines show the data centres that we have got joined up together. So this footprint will expand over the next 12 months. We, as we said in IPO, we are looking at new locations. Even looking at the map, there's some very obvious areas where we have nothing in at the moment. South America is blank, Australia, and kind of Middle East as well. All do not have a Beeks Cloud footprint yet, which we are looking to remedy as we go through the next 12 to 18 months. So I think Simon can go through the kind of financials at a high level from year end.
Thanks, Gordon. Key messages from our first full year as a listed company. Strong financial performance, lots of revenue visibility. We've been growing our annualised committed revenues month on month. As Gordon says, successful geographic expansion. We've moved in Singapore, a new data centre in London, and a new data centre in New Jersey. We are deploying infrastructure now in an automated fashion, the true cloud model, as Gordon says, declaring a maiden dividend, move back into profitability, and a confident outlook. As you can see, the small charts on the right, continued growth on the annualized monthly committed revenues and continued institutional client growth, which is the main focus. Slide 5 is summarising the results announcements. Top line growth of 41%, annualised revenues up 47%, and all the profitability metrics improving over prior years. Underlying EPS was 2.27 from a loss last year, and underlying EBITDA increased by nearly 260%. Following IPO, we now have net cash of over £2 million from a net debt position previously. The benefits of our model, infrastructure as a service, true cloud model, as Gordon says, clients paying subscription revenues, mostly monthly, about 5% pay annually in advance, very limited one-off revenues. That might be some install fees or decommission fees, but nothing we really count as our main revenue generators. Average entry fee for institutional clients is about £800 now. That's ticking up all the time as well as we get bigger. Average revenue for institutional clients, again, is about £2,500. Top 10 clients are still less than 30% of our revenues as well. So we're not beholden to one or two clients. We have a good core, and then we have a long tail of institutional clients, then all the retail clients behind that as well, who are coming in at the lower levels on virtual machines from £27 a month up to about £95 a month, generally. And we have over 1,100 of those. As I say, the focus on the institutionals, the corporate private client split is about 85% of our revenues are now from corporate customers, and only 15% from the private customers. Slide 6, just a graph showing the trends of revenues, gross profit, and EBITDA, all on the increase, and the increase in EBITDA over last year, which we'd explained on the IPO roadshows. We'd invested heavily in capacity and operational infrastructure for the next stage of growth following IPO and the increases in revenues. And because we have that capacity built in, additional revenues means additional profitability and improved profitability metrics. In terms of the balance sheet, probably 3 main points here. Improved net asset position following IPO, cash in the bank, £2 million now. Continued spend on fixed assets. It's a never-ending spend on fixed assets as we move into new data centers, building capacity, generate new customers and therefore new revenues. So we spent about another £1.4 million on fixed assets this year. Previously, and just before IPO, we took on additional finance leases because we didn't have the cash flows to expand. Those now have leveled off, and we'll be paying those down over the next 2 or 3 years as the leases come to their end. There are no plans at the moment to take on any additional finance leases or other borrowings. Cash flows, we generate cash. Last year is sort of noted, but because of the repayment of a lot of creditors around IPO and other creditors, those are all now paid off. We spend a lot on kit. We generate cash every month, and we reinvest it basically straight back into the business and into paying off our finance leases and associated costs.
What is your payback period if you go into, let's say, Singapore? What would you expect your?
So when we're deciding on new location, the call we make is if we can see OPEX costs being neutral within 12 months, we will do it. So outside of the initial capex investment of sending the network and the first tranche of hardware, we're really looking for break even within 12 months. Hopefully better, but that's the kind of line in the sand.
That's on a monthly basis?
Yeah.
Sorry, I had to say on the cash flows that we paid down a lot of creditors around IPO time, now fully up to date with those, and we generate cash monthly and reinvest that straight back into the business.
One thing that struck me was the fact that you'd written off, you'd capitalised and then amortised the spending on software and related activities, and there's nothing wrong with that. It hadn't been a feature of the sunk cost note, so I think they were forecasting about 700,000 of capex, whereas I think you delivered the 1.4. Had you not capitalised, and that wasn't a feature of the sunk cost number, then you would have probably been looking at a bit of a miss.
But we knew we were going to. The software development has mostly been in this financial year. So we've recruited, and most of the recruitment has taken place in the second half of the year. And we've recruited, therefore, to build the portal.
Yeah, I mean, previously we didn't, other than the DDoS offering, we didn't really have a software team per se. So over the last 12 months, we've expanded on that quite considerably, and we will going forward as well, because there's a lot of new projects to be surfaced through the portal as well that are software related.
So that incremental capex that was over and above the sunk cost note, is that building the portal?
Some of it, and some of it is going to new data centres ahead of where we thought. So in the extra London, Halsey, those are opportunities that we took and had to capex.
Yeah, and as part of pushing forward in self-service, before IPO, we kind of had anywhere between 50 and 70 servers available as free capacity at any one time spread around the world. Because we're pushing into self-service more, we've had to increase that level of capacity up to about 200. So we now have a much higher level of capacity available for clients to build out into. So that was an extra bit of spend as well now.
So I suppose if one looks at the revenue side, there was a miss for both the current year and next year. Gross margin wise, things look very good, particularly in H2. I think they were 59%. And then you've got this 300,000 or 400,000 of costs, which is quite legitimate amortization, but wasn't in the forecast. So I'm trying to understand what's moving here. So you've got worse turnover than expected, better gross profit than expected, particularly in H2, and then you've got the one-off, or not the one-off.
In terms of the better gross profit in H2, I think what you need to do is look at the whole year. We had some issues with suppliers who we were getting credit notes from. Cancellations hadn't been put through on their invoicing, etc., etc. Now, those hadn't been resolved at half year and came back in the second half. So, if those had been resolved in the half year, we'd have taken those credits in the half year. We couldn't take the credits because nothing had been resolved. We were still in discussions, negotiations, debate with some of our suppliers, which was for reasonable sums of money. So some of that has come back, reasonable chunks come back in the second half, which slightly inflates gross margin in the second half. So if you look at the year as a whole, the 53.4% is where it should be.
And that's what you'd expect in future.
Well, we're ticking up all the time, and we're looking at mid to late 50s gross margin in the future.
And the reason for the sales being a bit lower than you had anticipated?
So a couple of things. So and we've got a slide. If you look at slide 15. There was a couple of things. Our biggest client, American broker, went into Chapter 11, which we kind of knew about, but the decline from then was higher than we'd expected. Spend decreased by 90%. If you look at slide 15, after IPO, we had a kind of unseasonal dip in our new business, and that was related to some issues around the new website and release of the new website to support the IPO, and that took a couple of months to resolve, which affected some revenue numbers. We also, with our new biggest client, had a couple of very bespoke deals that took 3 or 4 months to deliver. So again, caused a bit of an impact in terms of revenue. But as you can see from, again, the kind of exit on slide 15, the last quarter of last year was the strongest quarter we've seen in terms of new business sales and wins across the board. So a couple of issues after IPO, which we've resolved, and we've finished the year quite strongly. So if you look at the exit number, it kind of shows that we've caught up a little bit in terms of the delta between the original forecast and reported revenue.
But your brokers pulled back next year's or this year's forecast, so you're not expecting that, which I'm surprised given the strong Q4.
Yeah, because July and August are historically very, summer months are quieter months. So I think we're being conservative in terms of, and realistic in terms of the revenue line. It's still 45% growth year on year. I think the profitability metrics have nudged up slightly. So while being a bit prudent on revenue, I think we've upped our profitability calls. So we exited the year a little bit behind where we expected to be in revenue, and on the back of that we adjusted the revenue call for the year going forward.
And because of the large capex spend, it's difficult to understand how much free cash flow this business is able to generate. And I'm just wondering what proportion of the capex, ignoring the spending on intangibles, is sort of maintenance capex, i.e. replacing existing servers, and what part is expansion?
So at the moment, the majority is expansion, and we, because of the way we have grown, we've grown incrementally. So it wasn't as if we've gone out and spent £1 million or £2 million in capex in one go. We have built the business, in small capex investments. So we have a kind of 4-year depreciation strategy, and we will, it'll still be 80-20. 80 will be new capacity, 20 will be kind of rolling replacement, I would expect, as we go forward into the future years. So slide 10, areas that we to talk through. So how are we going to continue the organic growth? So things we've done over the last few months, we have done our first deals in the world of cryptocurrency. So we partnered with the Gemini exchange out of New York, which is the Winklevoss twins crypto exchange. So we now connect directly to them in New York. We have our first customers using that service. We are in discussions with a number of crypto exchanges to further that offering, and we're really seeing a maturing in the crypto hosting and connectivity market. A lot of them are now looking at some of the proper financial data centers and the way that classic exchanges now offer clients to connect with direct private connectivity. Previously, that wasn't available within the crypto world. So I think that the crypto asset class, if you like, is a big opportunity for us over the next 12 to 24 months, and it's an area that we're spending a lot of time and effort focusing on. We also took our first step into equities, so we connected again in New York to the IEX exchange, made famous by Flash Boys and Brad Katsuyama, who was one of the main subjects of the book. So IEX are trying to change the exchange model in the US considerably. They do not charge for market data, unlike some of the larger classic exchanges who charge anywhere up to $30,000 or $40,000 a month to resell their market data. So we can now offer a client full book US equities market data over a private connection within New York. And again, we have seen some clients take advantage of that already. We had our first fixed income project win earlier in the year. under NDA on it, I'm afraid, so we can't go into it in much more detail. But again, we've seen some further opportunities in that asset class going forward. So if you look at our historical asset classes of Forex and futures, which we're very, we've serviced for a number of years, we now have at least a toehold in all of the asset classes. Some of them, like equities, we're only kind of scratching the surface, but we can now have a meaningful conversation across any asset class that any financial institution wants to have a conversation around, and that will continue. Geographic expansion will continue, as I said in the early part of the presentation, with some very obvious areas for us to go into over the next 12 to 24 months. And the connecting to venues will be a never-ending process. We put new ones in every weekend. They only go in at weekends when the market's closed, and that shows no sign of slowing down. And that great for us. It's part of our USP, and we welcome connecting to any part of the financial ecosystem. And on the development side, so yeah, as I said, the partner portal or the self-service portal is fairly unique in financial services industry. We don't know anyone else who's trying to offer services this way. It's more common in the generic cloud providers, but in terms of giving people access to financial data centers, we don't believe that there's anyone else that is doing that with a self-service portal, and really is going to be a key part of our strategy going forward. Every customer interaction, will be support, sales inquiries, backing up infrastructure, will be done via the portal. So continued investment. We joined the Equinix Cloud Exchange, which is we are part of the Equinix ecosystem. Equinix is one of the largest data center providers in the world, and they have a service that allows people to connect to cloud providers very simply and very easily, and we are now part of that exchange. In terms of investment, so it's mainly been people and sites. So we have one of the big benefits of IPO, soft benefits that we didn't realise before getting in, is the calibre of people that we've been able to attract since we've been in the public domain. Some of the very experienced professionals that we've hired over the last 6 to 9 months may not have joined us prior to being public. So it's given us people that we probably wouldn't have had access to before. So it wasn't something that we particularly thought about before IPO, but I'm happy with some of the very senior, very skilled people that we've hired over the last 6 to 9 months. We just took a new commercial director, Des Peck, who is based out of our new London office, 20 years experience in financial markets and very well known within the city. Historically, he's been involved in futures and options world. Opened the sales office in London, opened the sales office in Shanghai, currently still going through the opening of the Chinese entity, which is by no means a simple or straightforward or quick process, but that continues with momentum. And additional data centers as we've talked about. So market opportunity, we still see the algorithmic trading market, if you like to call it that, growing. It's expected to grow almost 10% compound annual growth up to 2025. We always get asked how many potential clients are there in the world, and it's a very difficult question to answer. And the way we've sized it is at any point in time, it's generally believed that there's anywhere between 10 and 15,000 hedge funds in the world. We know there's about 2,000 or 3,000 forex brokers. There's 1,000 or so cross asset class brokers, and then there's the whole tier 3 and 2 and 1 banking world, of which there's thousands of institutions. So there is a lot of financial institutions out there. We currently deal with around 200, so we genuinely think there's a lot of runway for us to go at.
Have you targeted them, or have they just called you?
So we've been, and again, I think I've admitted this before, previously we've been really bad at outbound sales generation. So previously to Des and his predecessor, we didn't really have a sales team. It was all inbound referrals. A lot of our business came from exchanges referring a hedge fund or a broker or a prop trading group over to us. Because we can get people up and running quickly, if an exchange signs a fund, that's great, they've signed a contract, but there's no one's making any money until there's trade flow happening. So it's in everyone's interest to get that infrastructure and connectivity up quickly. So historically, a lot of our referrals have come from exchanges or venues that we connect to, and we'll connect a customer quickly and then they'll pass another one on and pass another one on. However, as we mature and get target larger institutions, you need, for the initial sales and account management, you need face-to-face sales resource. So we are expanding it. Historically, we've not been great at doing the classic face-to-face sales, but it's a focus, and part of Des's remit is to mould and build a sales team that then can target the larger institutions.
And what would their sort of sales targets be? You know, in the next year, 3 years. You're a £5-6 million business now. What should it be?
Well, so we target our sales staff on closing X amount of monthly recurring revenue. We don't really monitor one-offs because there is so little of it, and it's not our business. But so each sales person has a target of monthly committed revenue closed, and Des has the overall company target, which is focused on our numbers to the market. The more salespeople we have, the more people contributing to the overall revenue. But it's getting the right people in the right locations with the right experience that will be the challenges we face over the next few months.
Sorry, and the figures that you quote about the market, 8.8 billion to 18 billion, these are what I would call the service income that you take part in, as opposed to the volumes traded on the exchange. Those would be humongous.
The volumes trading is trillions or whatever is above trillion. That's more what people will be spending on infrastructure.
Yeah. Could I just ask you? You said earlier, and it's relevant to this, that you pointed to slide 3 and said you can see the places we haven't got a data centre in yet.
Yeah.
They're all in the well, I assume they're in the southern hemisphere. But how important do you foresee those centres as being, given that you're in America, you're in UK, you're in Europe, and you're in Tokyo and Hong Kong, and what one might regard as the important places?
So they're still important. I mean, if you look at Australia, for instance, the ASX is one of the major exchanges in Asia Pac. We are not there. We are looking at it. Places like Brazil has got a very active market. We are again on the verge of doing something or not doing something in Brazil. So there are still important exchanges in the southern hemisphere. I mean, Dubai has got quite an active metals exchange. We find that some people don't tend to host in Dubai, they tend to connect and come out. So the southern hemisphere kind of looks neglected on the slides, but there are some important exchanges in there that we are looking at and considering. But they're not of the same size as a London or a New York, but they are still meaningful.
Perhaps where these two questions are coming from is, this is a £5-6 million business at this moment. Market's growing at 10%, but it seems there's a lot of capex required to go into new locations. You're already in a lot. Can't we produce a lot of growth just from where you are already? And if so, what is the sort of growth you might get over 5 years?
Given exact figures, and that's putting a 5-year forecast out is not an easy thing to do. I mean, we are, in terms of new business at the moment, we see about 40% of our increase on a monthly revenue come from existing clients increasing our services.
50%.
40%.
40%.
But that's increasing every month. And that used to be in single digits. So the more data centres, the more services that we offer, we see clients expand into it. And we will not just go into a data centre with a hope and see. We will do it with an anchor client. Like SGX, we've got an anchor client. We're looking at Brazil at the moment, potential anchor client. So we do it with some science behind it, but the majority of growth will still come from our existing mature footprint.
And is that just from volume, or is there a pricing element to that?
It's adding new services. So I mean, one of the things. So it comes from adding new connections. We recently released a much bigger server class. So previously, the biggest server you could get from us was about £700 or £800 a month. You can now get one that's £2,000 a month. That gives you much more compute power and capacity. So that will hopefully drive some revenue. So it's new services and putting more services into what we've got. At the moment, one of the big holes we've got is we don't offer backup as a service. So we have all these financial institutions. We've never claimed to do it. We get asked quite a lot. They have a regulatory obligation to retain their data, an off-site copy of the data. So one of the projects going forward is to allow that to happen via the portal. They can just back up their entire machine to an off-site location that's secure. So if that machine ever blows up for whatever reason, they just restore it from off-site, and it meets a lot of regulatory compliance. So things like that will we hope drive more revenue from existing clients. So slide 12. Short-term focus. So Asia is still the main growth market and main growth area in our world. All the brokers that we talk to, all the funds are all targeting Asia. China, hence the release in Singapore. So we will look at further increasing that Asian footprint over the next 12 to 18 months. Talked about South America. China we service from Hong Kong. And the regulatory view within China seems to change on how open they are to trading in general and different asset classes. So at the moment, we're going through the opening of the Chinese company. Once we've done that, we will put a sales and support team in China to support our Chinese customers and user base. But at the moment, I don't think we would deploy a physical infrastructure into a Chinese mainland data center. We will service it from Hong Kong and service it from some of the peering that we've already got into mainland China. And we need to exploit better some of the new asset classes that we've got into, crypto, fixed income, and equities, as well as continuing to kind of be the dominant player in FX and increase market share in futures and options. We've got active headcount for the next 12 months. We are currently looking for a CTO. We've got a number of senior roles and a number of technical roles and commercial roles that we're looking to fill. And then ongoing further, as I've said before, my vision is everything that we do needs to be self-service. It needs to be automated. Automating a lot of the tasks that we do will allow the business to scale. Instead of just throwing headcount at everything, we need to be being clever at that to maintain the margins that we've got. And to do that, we need to automate a lot of the manual tasks, repeatable tasks that previously we would have had to employ relatively expensive network engineering and technical engineering resources to do. So the portal is a very important piece of innovation for us going forwards.
Is that unique in the market?
In financial markets, yes. I genuinely believe it is. I don't know anyone else out there that can give you dedicated or virtual machines in the financial data centres that we operate in.
I remember last time that we met, it was taking a lot of time to onboard clients. Yes. So presumably you've now freed up that capacity.
Yes.
But you've reallocated it to further extending the portal so that it can do the backups and whatever else.
Yeah, so previously when we onboarded a client, we would physically put in assign the task to an engineer who would physically deploy the infrastructure, test it, do the networking. What we've done over the last it's been longer than that, but then the last year or so is to put IP into the portal, automating the tasks. So engineers are now doing engineering as opposed to deployments, and that's the plan going forward. Because you can't. I don't believe you can scale meaningfully by just throwing resource at it. Okay. And we will continue to add WAN capacity and connectivity, data recovery and backup we've kind of touched upon. So there's a lot of things going on that we hope will drive organic growth both to our existing customer base and allow us to win new clients going forward. And we are, continue to look for M&A opportunities. We have looked at some opportunities since IPO. Unfortunately, none of them have met our criteria of valuation and value and profitability and all that other stuff that we consider. So we will buy if it makes sense. If nothing makes sense, we'll continue to focus on organic growth.
Could you explain what you mean? What you buy if it makes sense? Buy what?
A competitor, someone who has capacity or something that we don't. There are competitors out there, and we have
what size?
Small to medium. I mean, there are a couple of bigger players, but as I said at IPO and after IPO, we are not about to start any reverse takeovers. It's not on the agenda. So we are constantly looking. But if it's not profitable, doesn't add value to what we do, is not growing, and the valuation is realistic, then we
If it's not a competitor, what might it be? Where is sort of the weaknesses, or where are the places you might want to?
So we have constantly considered buying an equities hosting business because there's high barriers to entry, and our equities footprint is it could be stronger. So we have talked about it. We have looked. Even the backup area, I mean, we instead of building it out ourselves, we could look to acquire. There's bolt-ons that are competitive takeouts, and then there's bigger, more strategic plays that are really adding value or adding capability to our offering that we don't currently have.
How would you describe your customer service at the moment?
Our business is about quality of service, right? It's not, because of the transactions and the values that goes through the platform, everything we do is about quality of service. We focus on it, we major on it, the guys know that we live or die by it. I think it's good. I'm biased, but we had an email last week from one of our biggest clients saying, listen, email to me directly saying the support team had done a great job and a piece of work for them, and pass on congratulations. That's unusual to get emails like that. So people are much more likely to complain than
I think when we last met, there was a competitor or competitors who were very good at the client account management, and giving a lot of TLC to the customers, and they were perhaps irritating.
I think we win on client support and technical satisfaction. I think, as I said before, we probably need to get a bit better on the overall account management, commercial aspects of it.
So in that need to get better, where are you in that process?
So by expanding the sales team means we can go and talk to and have relationships with more of our clients. The problem we've got is, and it's not a problem, but only 20 or 30% of our customers have English as a first language. So, there's only so far you can go, and there's only going to be so many customers that you can have that level of relationship with. We can't have, it's impossible for us. We have clients from 120 different countries around the world, and we can't have a quarterly meeting or a monthly meeting with all of them. It's just, but that's what the portal is for, and we are going to put more languages into it, so they're working in their own language. So it's a fine line of getting that level right between face-to-face and self-service.
And in terms of the churn rate in the year, how did that go?
So, okay, we have recently appointed a head of client services who was a customer, and again, it was a nice thing. He was a customer for a long time, and approached us about a job. So he has been employed to look after customer retention and customer satisfaction. That's all he does. He has a target to ensure customer churn is 1% or below per month. And you get churn because people turn up services for a temporary period, and that's part of the business model. So it's never going to be zero. But the target that we are looking for is 1% or below per month. of monthly revenue. And Martin's sole purpose in life is to look after the kind of top clients and understand if there's any customer sat issues. He's involved with pre-sales to ensure that what we deliver is what a client wants, so they're happy. So we focus on it. And
what's his starting position in terms of the current churn rate?
It's less than 1%. I mean, we see some spikes in it, and it can be a bit seasonal, because what happens in and around December when the markets are quiet, people will then sit and review their infrastructure requirements, and you see maybe a bit of a spike in December, a little bit of a spike in summer. Sometimes clients go bust, and you'll see a spike. So it's not, yeah, it can be spiky, but the target is on an annual basis to keep that under 1%.
And if they do decide to review their relationship with you, is it because they're exiting from the market, or are they deciding to insource or use a competitor?
The majority at the moment is they've exited from the market. I mean, because we are in the mid-market of financial institutions, some cease trading, some turn off services, go and trade a different market, come out the market completely. But that's the majority of what we see is people exiting.
And how often is it that you would see someone turn off services, employ services, say a month, turn them off for a given period of time and come back?
It's not that prevalent, to be honest. And it depends who it is. On the retail side, you do see a bit of that. People, retail traders with very high, well, not so much high leverage anymore. But you see a bit of monthly churn in retail. It's fairly unusual, unless we've got a customer who will come in and take a test and development environment in Chicago, test their algo, doesn't work, move elsewhere. But it's not hugely prevalent. So to summarise, then, slide 13. We continue to be profitable. Revenue will continue to grow. I think we're forecasting 40% plus for the year. I believe there are decent barriers to entry that allow us to defend our position. Putting the 200 connections together has taken 5-6 years of blood, sweat and tears at weekends to do it, so it can't just be turned up overnight. We have good relationships with venues and exchanges who trust us, who promote us, who recommend us. As we said, we're getting better at the one-to-one relationships with the direct clients, and people are still in financial services, especially that can be slow moving. The journey to the cloud is still in its infancy. There's still a lot more to come. Our overall market's still increasing in terms of automated trading. It is the preferred method of transacting in most of the asset classes around the world, and I think we've proven so far that we've driven the business forward, and we've got, especially now, we've got I genuinely believe a great team that will continue to push us forward over the next few years. Thank you, folks.
Thank you.